Inventory levels are an all-time high. Will low inventory levels send our prices sky high? Stay tuned to find out. Hey, if you're a homeowner, an investor, or interested in buying property here in South Louisiana, we have all the data that you need. Hi, I'm Jim Keaty with Keaty Real Estate, and this is your market update. So, real estate prices are a function of supply and demand, and months of inventory is how we realtors keep a pulse on what is happening with our supply and demand. The National Association of Realtors reports months of supply refers to the number of months it would take for the current inventory of homes on the market to sell given our current sales pace. Historically, 6 months of supply is associated with moderate price appreciation, and a lower level of month supply tends to push prices up more rapidly. So to keep this real simple, you can see a balanced market is where prices are stable, and that's somewhere around 6 months of inventory. But when we have less demand and more supply, our month of supply of inventory rises and price decreases. But when we have what we're experiencing now, more demand and low supply, our inventory, our month of supply decreases and prices go up. And that's exactly what we're experiencing in 2021. Looking at the inventory going back to 2012, you can see that we have hovered around 5 to 6 months of inventory, which would be considered a balanced market. And starting in 2020, we've experienced well below average inventory levels, reporting under 4 months of inventory since June 2020, and under 2 months of inventory for almost all of 2021. This lack of inventory levels it's actually created a seller's market, and our average prices have actually increased to $261,000. That's a 9% increase year over year. However, going back all the way to 2012, we've experienced a very moderate appreciation of just 2.68%. This is well below the national average. As this chart shows, going back to 1995, the average annual appreciation nationally is 4.14%. So where are we going? Well, McClare Bolton Smith, senior leader of research at CoreLogic, says, overall, I do think that 2022 will be another strong year for the housing market, albeit a little bit higher mortgage rates. And we do think home sales will continue to rise and actually reach a 16-year high in 2022. So all of the indicators are pointing towards an increase in prices in the future. In fact, if you believe we're going to experience some inflation in the future, this gives even more reason to believe that prices will most likely continue to rise over the next 20 years. If we continue to experience annual appreciation of 2.68% over the next 20 years, our average price will be at $440,000 in 20 years. But if we follow the national average appreciation, in 2044, our average price will be over $585,000. Either way, we believe prices will continue to rise in the long term, and the rate of the increase is really the only question. And if you look at the rental market, going back all the way to 1988, rent has only continued to increase, and there are no signs of that slowing down. If you know anyone who purchased a house or an investment property 2 decades ago, the only thing they regret is that they wish they would have bought more homes. Really, the only thing that they should regret is they should have bought 10 properties versus what they bought. I hope you found this information valuable. If you would like to receive these monthly market reports, or if you would like a full market analysis on your property, just click the link below or reach out to us. We'd love to help. Stay tuned for next week when I'll break down pendings, foreclosures, and interest rates. I'm Jim Keaty with Keaty Real Estate. Thank you for watching.